called the last week saying that there was going to be a short squeeze, and we head into today with, well, some shakeup in the plumbing that we have discussed in broader markets, and we are seeing the stress this morning in crypto, in the S&P 500, in the Magnificent Seven. We'll talk a little bit about Japan. We're also going to talk about what I consider to be the single biggest risk of 2026, and if the people that I listen to are correct, and my assumption is they are, then it's not about looking out below, and it's not about looking up. It's about understanding how capital flows into the system and how capital flows out. So we'll talk about morning momentum. We'll discuss the runner, as always, at 9 o'clock. And we'll talk about the risk of all risks. And I know that you know this, and I know that you've heard it before, but it's one of those things that we bring it up, and then it goes ignored, and then a couple of months later, a couple of weeks later, it pops up, and all of a sudden, everybody becomes an expert everywhere in Japanese monetary policy. Fantastic. All right, when markets have volume and streaming has volume, you have to be more specific. Okay, you got it, Big Dave. All right, so let's do what we always do and remind you why we are here. Look, we had a big move last week, and what I loved about last week's rally was the fact that absolutely nobody anywhere in the media appears to have any understanding of what the hell actually happened. Did you know that last week's run was the best Thanksgiving week run since 2008? Now, that should be a little alarming to people because, once again, it's been 17 years, and yeah, it's only 4 days in that week, but how is it that we aligned with the 2008 level when that week in 2008, the United States government bailed out Citigroup and started TALF, one of the largest injections of capital in the financial system? This isn't complicated. It's all policy driven, and it's all driven not by risk off and risk on and all this idea about what the Fed funds rate's going to be in December. No, this is about plumbing. This is about liquidity. This is about how markets work. We were oversold. We did see levels that were basically things we had not seen before. We saw insider buying tick up. We saw zero breakout stocks. We saw a market primed for a squeeze. And we just came to a level that had not been accomplished since, well, the, at the time, largest corporate banking bailout in history, after the Federal Reserve and the Treasury and the U.S. government had already announced TARP. Citigroup was still getting money, and TLF was still on tap. So that's where we are. A very precarious and unusual environment, and all of the challenges that we have right now are right back where we started 2 weeks ago. So that's why is today a trap day? Where is smart money positioning? What are the top screens? What are the things you need to be looking for? Recognize this is not a, hey, risk on moment once again. In fact, this morning is looking a little bit risk off, and I'll explain why and what that means. Now, momentum, you will recall, last Monday, last 2 Fridays ago, was in the dumpster. The S&P 500 reading was down in extreme breakdown mode, and we actually had no stocks on the S&P 500 on around that Thursday 2 weeks ago. Nobody was up 5% in a week and up on the month. And now it's like we're in the middle of just the most insane rally that we have witnessed going back to, well, I guess April. The Qs are neutral on our intraday. The IWM is neutral, and the Russell S&P 500 is, well, net total. The IWM didn't have any breakdown stocks on Friday. That's where we were, and we're still red on the larger daily reading. That's how deep down things had gotten. So the S&P 500 has absolutely come back, and now everybody's bullish and everybody's optimistic, and we're talking about Santa Claus, and the underlying market is saying, slow down. Slow down. Futures for the Dow, the S&P 500, and the NASDAQ opened weaker this morning. Traders entering December with caution, a little bit of a risk-off tone ahead of the macro data and the central bank speeches this week. And really all you need to know is, well, Bitcoin. There she is. There's the devil in the details of this market. Because at the end of the day, Bitcoin is a pure proxy of what is happening with capital and flows in the broader economic environment. Now, here's the thing, right? We talk about Bitcoin. I think my wife just came home. I think she's sick. That time of year. But liquidity as a proxy, Bitcoin is the purest, basically marginal liquidity in the financial system. And its pullback, a 5% move down, should be a warning sign and a signal of, hey, what's going on? What's happening? Because at the same time this is occurring, silver prices are going to 58 and gold is back at 4,300. That is the disconnect between gold and Bitcoin. Gold being a monetary inflation hedge and Bitcoin being a liquidity proxy. Two huge differences in what they do and how they operate. But today, the S&P 500 under some pressure, and here's the key thing. Here's what we have to actually be focused on. This was a very volatile November. It was the worst month for momentum stocks since January 2023. If only there was a signal that could tell people that it went red, I don't know, on October 30th, and the S&P 500 chopping around and small cap worthless stocks getting kneecapped for the duration of the month before that rallied into last week. But that said, the focus right now seems to be on caution over optimism, and a weak open could drag equities lower. So what's doing this? What's really doing this? It's Japan. Oh, we're doing this again, aren't we? Yeah, we are. We want to have that conversation once again. Japan's 2-year yield just hit the highest since 2008. And they basically said we're considering a rate hike. Markets are now pricing in an 80% odds of a rate hike by Japan. And why does this matter? Why does it matter that Japan is going to potentially raise interest rates? Well, this has been the world's quiet liquidity engine for a very long time. And if a rate hike pulls capital home, this puts pressure on the carry trade, it strengthens the yen, it lifts global yields, and it drains leverage and capital everywhere. This is the single biggest story in the financial markets today, and it's not even close. So we will be watching the EWJ, which is under some pressure right now. But this is important because, again, it reflects broader impacts on equities and risk and plays into that 2026 risk that we are going to discuss after we talk about the runner. Bitcoin, Ethereum, the FXI, the EWJ, and the DAX, all in focus. High beta stocks, all in focus because, again, of diverging monetary policy. Japan signaling a possible rate hike. The yen strengthens. The global carry trade goes under pressure. The yen increases at a time that the United States government is talking about more short-term duration to flood and deal with our ongoing debt, weakening our dollar, and the likelihood of the Fed easing. Now, the story traditionally would be, hey, they're going to pump. We're going to see QE. That's going to be bullish for U.S. equities because paradoxically, it has been in the past. But the risk is changing because policy is changing. We're going to talk about that in a moment. For right now, the markets are pricing in a Fed cut. Right now, that's currently 90% odds, I believe. Let's look at CME Fed Watch for a little bit of a insight into what's going on there. Yep, 87%. The Fed futures rate now implies a near certain rate cut next week. So when dovish expectations are fully priced, markets can become fragile. There's no surprise ease left to trigger upside, and stocks will now trade on positioning and data, hopefully not Fed hope. And that sets up risk. That December could disappoint, but it also sets us up for a potentially choppy period as we head into Third Friday and triple witching in around what I believe December, what is that? 15th? No, 16th, 17th, 19th, 20th. One of them. We'll figure it out. We'll get there. Not that big of a deal. Anyway, we saw the Russell with a huge move last week. The developing move on the expectation of the rate cut, but also ongoing liquidity softening. It's very, very important this week that we keep in mind that there are a couple other stories emerging, right? If big tech is softening, small caps may continue to get off the ground after that big move down that we saw over the last month and a half. But if the rate cuts don't survive, these stocks will get obliterated. That's the battleground for December positioning. It's all about rate cut expectations for the Russell. Now, the other thing that is in focus this week, though, is that Trump's Fed chair decision is supposed to come. And the expectation is that Kevin Hassett is going to be the presumed nominee. A shift from Powell, Yellen, and Bernanke, which is a tradition of continual monetary support, would be a huge policy change toward more aggressive rate cuts and a more supply-side economic view heading into 2026. And even though I am a supply-side guy, the reality is this. It is a transitional form of policy, and it can come with a lot of pain. The question is, how much pain are they willing to tolerate, and will Hassett turn into Powell, turn into Yellen, turn into Bernanke when the going gets tough? Because the way that the system operates can unwind very quickly, and that can lead to a host of problems because the system, as it is designed, was designed under the Bernanke regime, and it has been 17 years of loose monetary policy, quantitative easing, and a asset-driven boom here in the United States that has made the U.S. the only game in town. And I'm going to show you a chart in 10 minutes that highlights where the real risk lies in 2026 and why it's going to be very important that every day you come in and you see this. You know if we are in positive or negative momentum conditions, because the moment that this stuff breaks down, things can go very quickly. Hedge funds can drop, start selling. And when we hit these extremes, that's where the reversals come. That's where the real opportunities will lie. And if we're anything like 2022, it's going to set up for about 1 or 2 trades every month that can deliver massive, massive gains. But you have to be willing to take the risk, and you have to play the probabilities assessed based on the momentum readings themselves. It's 9 o'clock, which can only mean one thing. Where are you? Come on. I'm so cute. Can I recommend a good textbook on the carry trade? I would just recommend that you go on ChatGPT and ask questions. Probably the best thing that you can do, because really at the end of the day, the carry trade is, there's a couple of guys who've written some things about it. Jamie Lee did. I think it's called The Rise of Carry, something like that. Not John Kerry, but Carry. Krugman has written about it, obviously, because what hasn't he written about? But I would focus more on the more practical guys who have really dug into this. Look at Michael Howell's Capital Wars. It's a little dense, but it does a really good job explaining the weaponization of the yen over the last 5 to 10 years. And why, again, that carry trade is so critical. If you want to really go somewhere out, you really want to understand cross-border flows. So, again, it's not just the Japanese carry trade historically. That is a form of currency arbitrage that is as old as Ricardo himself. All right. Yes, the carry wood trade. Oh, man, you want to talk about a night that I got my hopes up? That would have been Game 7 of the NLCS in 2004 after Kerry Wood hit that game-tying home run. It was euphoria in the Piano Man in Wrigleyville, and then it just went away. IQV, Quivia Holdings. Wow, look at you. Look, this is a market that is being absolutely held up by the rally in healthcare that has really ascended over the last couple of weeks. Healthcare has just been on absolute fire. And the momentum in healthcare goes back a lot longer than the, one moment. Goes back a lot longer than where we were just, 2 Fridays ago when we kind of projected that there was going to be a squeeze on tap. Healthcare stocks have been positive going back roughly all the way back to May 15th. We've had a couple of short periods of selling like what transpired 2 weeks ago with broader market, but it really has been a very solid year on the healthcare front. And IQV is a name that continues to pop up time and time again. Higher highs, higher lows, strength along the way. What we're going to turn around and look at is really this 30-minute chart. If we can stay above this 229 level, I'm looking for a next leg up at 235. DRS. One of the great stories of 2020. It started with all of the focus and capital rotation that transpired, largely on the back of, well, there's going to be all this trade problems. Let's just continue to pour in. No, that's not what this is. This has been a multi-year run from the liquidity lows in late 2022, and DRS has sold off immensely. Big momentum move that transpired in recent months, going back to August with the rest of the market. The question is, can this wake back up? And with the reindustrialization of European and Israeli defense, the key thing here is this. If money flows out of the United States, and I'm going to lay this all out for you in about 6 minutes, DRS is the type of company that would benefit. And once again, U.S. spending on defense is not going anywhere. But the big question, again, is around the valuations, and we'll talk about that momentarily. But my hope is that DRS can get a little bit of a squeeze, take us back to at least 35, maybe get us back to 37, buying in the money at 34, selling out of the money at 35 or 36 out a couple of weeks. If this continues to roll over, that is largely on the back of an industrial weakness. Industrials have made a bit of a comeback in the last week and a half, pulling back to equilibrium. We will see if the industrials can hold and maintain their strength. TS is the last one on the list. Tenaris, good company, by the way. There is a lot of optimism around the energy markets. I skipped that slide. I apologize. But oil is climbing on supply concerns, inflation pressure reemerging, risk for cross-sensitive sectors. And it's the XLE and the CVX, and we get it. But it's the equipment players that are also in focus. And keep in mind, TS, by the way, you want to be focusing on a lot of the commodities they own, which is in the piping space. So here you go, TS, looking at continuation and a bounce back. I want to be a little bit cautious here, but the way to specifically trade it, looking for a reversal out of this low. Higher highs, higher lows. either retesting of that 40 level on that adjusted 50, which is 15 times 50, which is 750 minutes. Look at that math, Mom. 40 looking for that bounce up, and then a continuation in trend to the upside. Cheap stock to trade. You can just use the stock if you prefer. Downside's where my focus is going to be, and it's going to be in stuff that, look, you already know. Look, NVIDIA, I didn't add, and I'm going to just throw it up here. This chart is just screaming 165 in my face at the moment. And this has been, the negative channel that we have seen, lower highs, lower lows. Remember, stocks don't go straight down. And what we continue to see in a 30-minute chart, I mean, it doesn't matter how you pull it back. You can see it in the hourly. You're looking for these just key technical channels, right? And you see these squeezes up, and then it rolls right back over. This is how markets operate. This is how algos talk to one another. This is how funds sell into pressure. They're not going to sell when there is zero buying pressure in the market like there basically was back in these periods here. Instead, they wait for some bidding to come back in. They see a little bit of pressure. They see stocks move back to the 20-day moving average, and then they dump right back in to the bag holders who are willing to scoop this stuff up. So lower highs, lower lows, looking for a continuation. I legitimately, if this weakness continues and persists and our signal turns negative again, which I wouldn't be shocked if it happened by Wednesday, 165 for NVIDIA is kind of where my head is for the next move lower, and then a potential bounce back to 170, 172, and then we'll see if that trend continues. XPO, I have a very difficult time being very bearish on a lot of these different types of names, but the key thing that we're looking for here is just a stock that has been overextended, had a nice positive run from 125 up to 142. These are the types of stocks, again, going from periods that felt like oversold conditions to now these kind of overbought conditions on RSI, MFI, looking for profit taking and looking to exacerbate that, like looking for this trend. We're near this top from that October 31st period. I'm not saying it's going back to 124, but if you can get me back down to 136, I can do a lot with that with short duration options. In addition, FLS is in play, Flowserve Corporation. Industrials. And these industrials, if you're going to do a pair trade, if you're looking for ways to go long an equity and consider industrials, go long something like TS and go short FLS, it would be fine. But nonetheless, we continue to focus more on the broader liquidity names, the bigger names, the stocks that have a significant amount of open interest, and of course, tight bid-ask spreads, very exciting, optionable stocks with short duration options. Hey, Walmart just had a nice solid run. We just saw all this big move, 10% move on Walmart in the last week and a half. And yep, we got seasonality and a lot of opportunities and a lot of focus, again, on the fact that it is the holiday shopping season. But just, again, the broader market is going to be thinking, hey, seasonality, cyclical, let's go into defensives. If broader market momentum breaks down, everything goes with it. So Walmart, where there might be that optimism and that narrative, particularly coming off a Black Friday, think a little bit contrarian because, again, the purpose of the market is to sell. HYMC, which is a stock that I continue to advise that people just sell put spreads on, just continuing to rally higher. That's the entire purpose of doing put spreads, where there is strength in momentum and strong insider buying. We saw that with Hycroft very recently, continuing the trend, higher highs, higher lows, momentum looking very strong, looking for another little bit of a short-term pullback, maybe get me back down to around 1063, $11, and then I'm back in looking for the next move to the upside. The final name is DG, Dollar General. Yeah, sure, whatever. Man, I really don't have an opinion on this company, but same thing, same story, same competitive pressure. I just look at this stock and I state, as we get into the narrative that I'm going to discuss in a moment, this has that feel of something that can continue to run for a significant period of time because of where we sit right now in this current market regime. All right. Real quick, let me check the chat. Great book. Kerry Wood trade. Yes, we're going to talk about the Kerry Wood trade later today. End of the year profit taking. I will be looking for end of the year profit taking heading into Third Friday. That is the 19th. Got it right this time. December 19th. The question comes on whether or not, if we go back and we look at the S&P 500 last year, a lot of people missed this, but we sold off it was a pretty marked, pretty sizable pullback that, people go, okay, well, it's end of the year. People are taking profits. This was actually a problem in the money markets. So that's really the big question. It's not necessarily going to be about profit taking so much as it's going to be about liquidity. And that's the real story here. That's the thing that people have to really, truly understand of whether or not there is going to be a massive exit from U.S. markets. Not because of anything that this market really did wrong, but because we may very well be near the top of this market in terms of global liquidity. Okay, let's do it. This is the most important chart in finance right now. A lot of people will just say, that's not that big of a deal. 19, 20, 21% of U.S. equities are owned by foreign investors. And nobody will really care because, well, back in 2008, it was 11%. Okay, let's just point something out, all right? Because my job is really in risk management more than anything else. And it's just to explain to people that sometimes the narrative that you hear isn't the actual right story. So right now, the big chatter happening in the financial system today is pretty simplistic. AI is a bubble. The dot-com era level, moves that we have seen transpire. Currentmarketvaluation.com. Oh my goodness, we are at levels of the Buffett indicator. Nobody knows what the Buffett indicator is, but here's the thing, right? The U.S. stock market value to GDP is at a level that we have never seen before. Doesn't matter. This is the simple academic way that the world thinks. But what people don't think about is the simplistic mechanisms of a market. Okay? The world moves on money that moves around like water. That's it. Money moves around like water. That's why we call it liquidity. Okay, this isn't complicated. When a lot of water flows into the United States, everything goes up. And the idea here is that it's not AI that's the bubble. It's the U.S. stock market. Since 2013, we were 33% of the global MSCI index. Today, we're 70. Okay? And a lot of that is fueled by lots of foreign ownership in the U.S. equity markets. Somebody talking to me? Oh, sorry. Okay. Now, why does this matter? When the water goes into the U.S., everything goes up. Stocks, housing, crypto, tech, everything. And it matters because we've relied a lot on Japan from the way that they have engaged in these trades. And it's not just Japan, it's anywhere in the world, anywhere that there is a starvation for yield, whether it is sovereign wealth funds, whether it's wealthy investors in China who are buying up housing in San Francisco or even in Vancouver, which I know is in the United States. I'm just pointing out foreign real estate investment, people buying into U.S. equities, people buying into U.S. plants, whatever it is. They're buying it because they were yield starved for a long time. So they came here to the United States because when we printed money in 2011, 2013, when we engaged in QE, interestingly enough, that lifted our equity markets. It created a paradox in which foreign investors came here to chase our returns because they couldn't get anything out of their domestic economy. They couldn't get anything out of their central banks. The Bank of Japan had interest rates at 0. The Swiss bank had it at 0. In fact, it was negative in places in Europe. In real investment, tens of trillions of dollars, over $10 trillion at least, in negative yields, real yields. So money flew here. Okay, when that water slows down, prices stop rising, and that water starts flowing out, things break. That's it. That's the whole system. And this is the essence of what is known as cross-border capital flows. I know how hard that sounds, but the mechanisms of money flowing across borders is the reality of how financial systems work. Interest rates, what the Fed does, doesn't matter because the cost of money in the global financial system is not what the Fed funds rate is. It's Forex. It's what the US dollar compares to other currencies. And by the way, the Forex market dwarfs the bond markets, or dwarfs the US equity markets, and we have to pay attention to these flows. Over the last decade, the United States got a giant hose of money from Europe, Japan, China, big investors overseas. Why? Because they could earn more here than they could at home. That's it. So when foreign money came here, the same way spring rain comes to a river, quietly but massively. And now that hose is slowing down because countries abroad are raising their interest rates. They have weaker economies. They have political fights. They have their own currencies doing weird things. And in a lot of places, they're going to need their money back. And where is their money? It's right there in that chart. So if they start pulling out of the United States instead of sending it in, it creates a macroeconomic challenge. And Japan makes it worse because Japan has been the single biggest water pump in the world. Japan kept interest rates near 0 forever. That meant people all over the world borrowed money from Japan and they invested it here in the United States. It was a great trade. It was an amazing trade. It was basically this: borrow cheap in China, make money in America. But the only thing is, it only works as long as Japan stays quiet. Now Japan is wobbling. And when the main pump shakes, the water supply shakes too. That has been what has been occurring going all the way back. It's been a while, but I've been saying time and time again, we had a massive 4 sigma event happen in August of last year in Japan. And we still don't talk about it. And we started to talk about last week. People were saying, oh, the markets are up because there's so much optimism around Fed funds rate. They dropped $135 billion from the sky in Japan on November 21st. It was a major policy effort to stabilize. And we've seen this game before because they did the same thing a year ago with forward guidance. This is how things start. And when money reverses, the U.S. markets don't just go down, they deflate like a balloon losing air, and not all at once, but enough that everything feels a little smaller, a little tighter, a little more fragile. And this is why liquidity experts say we are near a peak. That's the key thing. The water is as high as it's going to get. And from here, it will start to go back down, but it will ebb and it will flow and it will act like a tide in an estuary where the water will come in from the ocean and come out. I'm thinking of the bay down in Naples, Florida. But the reality is this, okay? When markets rise, when money flows in, markets fall when money flows out, and now the money that came from overseas may start to leave. You don't need charts, you don't need jargon, you don't need math. You just need to understand how water levels work. And if you don't understand how water levels work, I don't think anybody can help you. So look, this isn't doom. It's not a massive, oh my God, the sky is falling. It's just plumbing. The water was high. Now it's starting to gently drain, and that can lead to these overreactions. But I want you to remember this. I want you to just be very, very aware that in this environment, The narrative that you're going to hear is going to be about AI. It's going to be about all of these other things that at the end of the day still don't comprehend what happened with the tequila crisis in 94, 98 long-term capital management. What actually was the dot-com bubble popping? What was the foreign flows, the FX flows, the global liquidity flows that impacted 2008? What happened in 18? What truly happened in 2022? And what happens when we get to these peaks? And how do you shift your money, and what do you start to focus on? Right now, my attention is in the consumer defensive area. For now, doesn't mean I'm going all in yet. I'm going to continue to watch momentum and see how it shakes. If we go negative, defensives become an interesting play. And then we have to start having intelligent conversations about assets that can't leave here, that kick off cash, and also are defensive, particularly as we head later into 2026. If you have questions about anything I just said, write support at TheoTrade.com. Put Garrett in the subject line. I will get back to this. I'll dig deeper into this today in the last hour. But again, for now, the story is not the AI bubble. It is the America bubble, and it will remain so through the peak of this liquidity cycle. Have a great day, everybody. We'll catch up soon. Take care.